Welcome back to another episode of Investment Crusader. Subscribe to the channel now, so you never miss any of our latest and greatest videos as soon as they're released. In this video, we're going to be taking a look at what hedge funds are. Let's get started. What is a hedge fund? Hedge funds are actively managed investment pools whose managers use a wide range of strategies, often including buying with borrowed money and trading esoteric assets, in an effort to beat average investment returns for their clients. They are considered risky alternative investment choices. Hedge funds require a high minimum investment or net worth, excluding all but wealthy clients. Understanding the hedge fund. The term hedge fund helps tell the story. The manager of any traditional investment fund may devote a portion of the available assets to a hedged bet. That's a bet in the opposite direction of the fund's focus, made in order to offset any losses in its core holdings. For example, the manager of a fund that focuses on a cyclical sector that does well in a booming economy, such as travel, may devote a portion of the assets to stocks in a non-cyclical sector, like food or power companies. If the economy tanks, the returns of the non-cyclical stocks should offset the losses in cyclical stocks. In modern times, hedge fund managers have taken the concept to an extreme. In fact, their funds have little to do with hedging, except for a few who stick to the original concept of the hedge fund, known as the classic long/short equities model. Risky business. Hedge funds are free to use riskier strategies in riskier ways. Notably, they frequently use leverage. That is, they use borrowed money to buy more of an asset in order to multiply their potential returns, or losses. They also invest in derivatives such as options and futures. In short, they are free to choose esoteric investments that conservative investors won't touch. Notably, hedge funds are not as strictly regulated by the Securities and Exchange Commission as mutual funds are. As might be expected, the appeal of many hedge funds lies in the reputation of their managers, many of whom are seen as stars in the closed world of hedge fund investing. These money managers don't come cheap. Hedge funds generally charge a fee of 1% to 2% of assets, plus a performance fee of about 20% of the profits. How hedge funds are categorized. Each hedge fund is designed to take advantage of specific market opportunities. They can be categorized into a number of broad hedge fund strategies such as event-driven investing and fixed income arbitrage. They are often classified according to the investment style of the fund's manager. Legally, hedge funds are often set up as private investment limited partnerships that are open only to a limited number of accredited investors and require a large initial minimum investment. Investments in hedge funds are illiquid as they often require investors to keep their money in the fund for at least 1 year, a time known as the lockup period. Withdrawals may also only happen at certain intervals such as quarterly or biannually. History of the hedge fund. Australian investor and financial writer Alfred Winslow Jones is credited with launching the first hedge fund in 1949 through his company, A.W. Jones and Company. He raised $100,000, including $40,000 out of his own pocket, and set up a fund that aimed to minimize the risk in long-term stock investing by short-selling other stocks. This innovation is now referred to as the classic long/short equities model. Jones also employed leverage to enhance the returns of his fund. In 1952, Jones converted his fund from a general partnership to a limited partnership and added a 20% incentive fee as compensation for the managing partner. As the first money manager to combine short selling, the use of leverage, and a compensation system based on performance, Jones earned his place in investing history as the father of the hedge fund. Key characteristics of hedge funds. How do you tell a hedge fund from a mutual fund? Here are a few big differences between the two. Hedge funds exclude small investors. Hedge funds can accept money only from qualified investors, individuals with an annual income that exceeds $200,000 for the past 2 years or a net worth exceeding $1 million, excluding their primary residence. Some set their minimums higher. Those rules are imposed by the Securities and Exchange Commission because it otherwise does not strictly regulate hedge funds. It considers qualified investors to be suitable to handle the potential risks that hedge funds are permitted to take. Hedge fund managers have a wide latitude. A hedge fund's investment universe is limited only by its mandate. A hedge fund can basically invest in anything: land, real estate, stocks, derivatives, and currencies. Mutual funds, by contrast, stick to stocks or bonds and invest for the long term. Hedge funds often use leverage. Hedge funds often use borrowed money to amplify their returns and allow them to take aggressive short positions. As was seen during the financial crisis of 2008, leverage can wipe out hedge funds, along with other big chunks of the economy. Hedge funds have a 2 and 20 fee structure. Mutual funds fees have fallen substantially in the last few years, hitting an average of 0.50% in 2020. Hedge funds, by contrast, use a fee structure that is called, in shorthand, 2 and 20. That's 2% of the assets under management plus a 20% cut of any profits generated. And with that, we've reached the end of this video all about what hedge funds are. Are any of you considering investing in a hedge fund? Get involved, and let us know in the comments section down below. If you enjoyed this episode and found it helpful and interesting, remember to leave a thumbs up before you leave. Also, subscribe to Investment Crusader and click the notification bell so you're always up to date with our latest releases. As always, thanks for stopping by and watching. See you again soon, in the next one.